We are covering these 5 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on LCID. Lucid Group Incorporated is a technology company specializing in designing, developing, and manufacturing electric vehicles, EV powertrains, and battery systems. It operates with a strong focus on in-house innovation, vertical integration, and engineering excellence, which has led to the development of its luxury EV, the Lucid Air. The company manufactures its vehicles at its state-of-the-art facility in Casa Grande, Arizona, and operates a direct-to-consumer sales model through retail and online channels. Recently, Lucid Group has been facing both growth opportunities and challenges. While the company has made significant strides in the luxury EV market, it has also struggled with ramping up production to meet demand. This has led to investor concerns regarding its ability to scale efficiently, as the company reported disappointing production figures for the Lucid Air in its most recent earnings report. Despite its innovative technology and strong brand in the luxury EV segment, Lucid has been grappling with supply chain constraints, cost overruns, and delays in manufacturing. Additionally, competition in the luxury electric vehicle market has intensified, with established automakers ramping up their EV offerings and new entrants vying for market share. This competitive pressure is expected to put continued strain on Lucid's pricing power and profit margins. On a positive note, Lucid has maintained a strong balance sheet, with significant cash reserves that should allow it to navigate the challenges of scaling its production. The company continues to innovate in areas such as battery technology, which could provide a competitive edge in the long run. Furthermore, Lucid's plans for future vehicle programs and technology innovations are expected to drive future growth, although the timeline for profitability remains uncertain. Investors should monitor Lucid's ability to address production challenges, scale its operations, and maintain its market position as competition increases. The company's strong technological foundation and luxury market positioning remain appealing, but its ability to execute on these advantages in a competitive landscape will be crucial to its long-term stock performance. Our review on AAL. American Airlines Group Incorporated is a holding company primarily engaged in operating a network air carrier. The company, through its subsidiaries and regional carriers, offers air transportation services under the American Eagle brand. It provides scheduled passenger and cargo services via a comprehensive network of hubs and global gateways. With a large fleet, American Airlines serves both domestic and international routes, connecting major cities across the United States and key global destinations. The recent decline in the number of Americans planning vacations in the next 6 months, reaching the lowest levels in 15 years, excluding the pandemic, poses a potential challenge to American Airlines' near-term growth prospects. This decrease in leisure travel could impact passenger demand, particularly in the coming months, as travel sentiment often correlates with seasonal peaks. With many consumers tightening their budgets amid economic uncertainty, discretionary spending, such as travel, may face headwinds. Despite this, American Airlines continues to benefit from its extensive network, strong brand presence, and cargo services, which could help buffer some of the effects of reduced consumer travel. Additionally, its regional carriers and cargo division provide diversification, with freight services continuing to be an essential part of its operations, even during periods of lower passenger demand. Investors should remain cautious about the potential for weaker leisure travel in the short term. However, the company's well-established position in both the passenger and cargo markets, combined with its large fleet, provides a foundation for recovery as travel demand normalizes. The outlook for American Airlines will depend on how effectively it can adapt to shifting consumer behaviors, manage operational costs, and leverage its network and cargo business to mitigate volatility in passenger traffic. Our review on BTG. B2Gold Corporation is an international gold producer with operating mines in Mali, Namibia, and the Philippines, alongside development projects in Canada, Colombia, and Finland. The company's major assets include the Fekala, Masbate, and Achikoto mines, as well as the Goose and Gramalote projects, which offer significant potential for future growth. The recent surge in gold prices, which has seen gold surpass the $3,000 mark, presents a promising opportunity for B2Gold. The rally, driven by rising trade tensions, economic uncertainty, and expectations of Federal Reserve rate cuts, benefits gold producers like B2Gold due to their direct exposure to gold prices. As a low-cost producer with significant production capacity, B2Gold is positioned to take advantage of this price boost, enhancing its profitability. Additionally, the company's diverse geographical footprint provides a level of risk mitigation, with operations in stable mining regions. As the company continues to ramp up production at its existing mines and advance exploration and development projects, there's potential for further revenue growth. However, investors should remain cautious of geopolitical instability, fluctuating market conditions, and potential cost pressures. Despite the current favorable market conditions, B2Gold's ability to manage production and operational costs effectively will be crucial for sustaining long-term growth and profitability. Overall, the company is well positioned to benefit from the ongoing gold rally, but external factors should be monitored closely. Our review on AAPL. Apple Incorporated designs, manufactures, and markets a broad range of products, including smartphones, personal computers, tablets, wearables, and accessories, alongside services like AppleCare, iCloud, and Apple Music. The company has built a robust ecosystem through its product categories, such as iPhone, Mac, and iPad, as well as its software platforms, including iOS, macOS, and watchOS. Apple has maintained a strong market position due to its ability to innovate and develop high-performance products, like the recently launched MacBook Air with the new M4 chip. However, despite these advancements, Apple has seen a notable 10% decline in stock price over the past month, primarily driven by broader market conditions and investor concerns. The recent dip in Apple's stock is tied to a wider market downturn, influenced by inflation worries, economic uncertainties, and market volatility. The company's stock has been caught in a broader slump, with major indices like the Dow and S&P 500 also seeing losses in recent weeks. Apple's performance has also been impacted by investor concerns over its delayed launch of advanced Siri features, which were initially teased as part of the iPhone 16 and promoted in commercials. These features, aimed at enhancing Siri's AI capabilities, were expected to make the voice assistant smarter and more contextual. However, Apple acknowledged that these features are still in development and will be delayed for several months. This has raised concerns about the company's credibility, as it had previously touted these features as a key selling point for the new iPhone lineup. The criticism of Apple's decision to publicly promote unfinished features has been sharp, especially from prominent industry figures who argue that the company may have damaged its reputation by overpromising and underdelivering. Despite these setbacks, Apple has maintained a long-term focus on innovation, including its push into artificial intelligence and the development of a broader AI strategy. The company's financial strength, bolstered by substantial share buyback programs and a diversified product portfolio, continues to provide a foundation for future growth even amid short-term challenges. In addition, Apple's ongoing investment in U.S. manufacturing and its efforts to expand its services ecosystem, such as Apple Music, Apple Fitness Plus, and the launch of the iPhone 16, could present future growth opportunities once broader market conditions stabilize. While the recent setbacks may affect near-term stock performance, Apple's long-term strategy remains intact, and its ability to innovate and adapt to market dynamics could help it regain momentum in the future. Investors should keep an eye on Apple's upcoming product launches, particularly around AI and the delayed Siri features, as these could play a pivotal role in the company's performance over the coming months. A review on SMCI. Super Microcomputer Incorporated is a provider of application-optimized IT solutions, specializing in accelerated compute platforms for various sectors, including cloud computing, artificial intelligence, AI, 5G, and edge computing. The company offers a range of products including servers, storage systems, networking devices, and server management software, and operates globally with a significant presence in the US, Asia, and Europe. Recently, Supermicro has faced fluctuations in its stock price, influenced by a combination of broader market conditions and recent earnings outlooks. Supermicro's stock has seen a recent dip, with shares down by approximately 7.6% over the past month, outperforming the Zacks S&P 500 composite but underperforming the computer storage devices industry, which experienced a more significant decline of 23.7%. The company's stock has been trending heavily among investors, reflecting heightened interest in its near-term prospects, but the stock's recent performance, including a 46% drop from its recent high, signals a bearish trend. For the current quarter, Supermicro is projected to report earnings of 52 cents per share, representing a decline of 22.4% from the same period last year. Over the past month, the consensus estimate for the company's earnings has been revised downward by 38.5%. While the company is expected to report an annual earnings growth of 15.8%, recent revisions to earnings estimates suggest potential challenges, leading to a Zacks rank number 4 sell, which indicates that the stock may underperform in the near term. In terms of revenue, Supermicro has seen strong growth. The consensus sales estimate for the current quarter is $5.34 billion, reflecting a year-over-year increase of 38.6%. For the upcoming fiscal years, the revenue is projected to grow by 59.1% and 39.1%, respectively. Despite these positive revenue projections, the stock has struggled with recent market volatility and investor sentiment, exacerbated by earnings estimate revisions and its premium valuation relative to industry peers. The company is graded D in terms of valuation, indicating that it may be trading at a premium, which could limit future stock price appreciation. Supermicro has delivered solid earnings and revenue growth in the past, including a recent earnings surprise where it reported $5.68 billion in revenue, exceeding expectations by 0.5%, and an EPS of 61 cents, outperforming the consensus by 1.67%. However, the company faces challenges in the near term, with market conditions impacting investor confidence and potential delays or uncertainties regarding its future earnings performance. In conclusion, while Supermicro's long-term growth prospects remain strong, especially in sectors like AI and cloud computing, its short-term performance appears uncertain. Investors should be mindful of the recent downward revisions in earnings estimates and the stock's elevated valuation, which could put pressure on its price in the near term. Please subscribe, give the video a like, and watch more from our playlist. Thanks.